Hello everyone and welcome to my channel. In this video we're going to talk about one of the most intriguing tech companies that has been trading on a Nasdaq, Nikola Motor. It has been one of the rising stars of the 2020 era when the EV seemed to be on the verge of taking over the world. Of course, it's not how things have necessarily played out, and today people are left wondering whether there is any possibility for Nikola to recover its former glories. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. In recent days, Nikola has been trading around the 87 cents level, marking a 5% increase on the level observed just 5 days ago. Despite the short-term uptick, the overall trend still remains bearish, with a 14% decline over the past month and a substantial 35% decline over the past 6 months. Given those factors, there are numerous reasons why the pressure for further sell-offs is likely to persist in the foreseeable future. Nikola stands out as a company whose reputation took a massive hit when its founder and former CEO, Trevor Milton, faced accusations and eventually conviction for lying to investors and committing fraud. So, despite facing significant challenges, Nikola has managed to survive and endure surprisingly well, in fact, in weathering the storm of the electric vehicle bubble collapse, and at least much better than many other companies. The company has grappled with internal issues such as supply chain disruptions, cash flow challenges, and a general erosion of trust. Additionally, Nikola is significantly impacted by the evolving investment conditions, with the allure of safer and more predictable investment options drawing capital away from equities. In a recent statement, Nikola's CEO, Stephen Gursky, expressed optimism and projected that 2024 would be the best year in the company's history. I mean, while there may be improvement compared to 2023, it is unlikely to reach the heights of 2020 when the share price soared due to strong fundamentals and widespread expectations for the electric vehicle sector. Currently categorized as a penny stock, Nikola is striving to maintain relevance and to stay listed on a Nasdaq. Anticipating potential volatilities in the coming month, I believe that there may be a place for Nikola in certain portfolios. With that being said, here's a quick look at the technicals. The trading volume of Nikola Motors is recently around 83 million shares, compared to an average volume of 135 million shares. Over the previous 52-week period, the price fluctuated between 52 cents and $3.71. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be very easy to influence the stock price, but the low liquidity could also mean that the demand may be limited as well. And when we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is too large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The current market cap is around $900 million. As we compare the current price to the historical price fluctuations, the stock is 32% higher than the 1-month low, 32% higher than the 3-month low, and 68% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to head next, the implied volatility is 140%, compared to a historical volatility of 115%. The put-call volume ratio is currently around 42%. It's normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 16,000 contracts a day versus the 30-day average of 98,000. Regarding the open interest, the most recent volume of open interest is around 1.6 million contracts compared to the 30-day average of 1.8 million contracts. In terms of shareholder structure, institutional shareholders own about 24%, which is quite significant given the scale and history of the company of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Citigroup. It's always encouraging to see some participation in the stock's equity because it offers a layer of stability and a token of reliability in the medium to long range. It means that overall the market still believes that this company can deliver value in the long term, which is an important factor to consider for investors. Personally, I consider the minimum threshold to be around 25 to 30% of institutional ownership for long-term holding. The current short interest is around 18% of the total float, and 50% of the transactions come from the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the shorts coming from the dark pools, it could suggest institutional positions taken to short the stock and that there would be potentials for a short squeeze. However, in the case of Nikola, I would also argue that this might just be people who, without being considered altogether, believe that Nikola is a bad investment and therefore want to short it. So I don't. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So, really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. In summary, I believe that investing in Nikola is advisable only for portfolios with an exceptionally high risk appetite and a very good tolerance for volatile and risky assets. The current market conditions may present a favorable entry point. Exercising caution and waiting for additional support before allocating more capital is highly recommended. Short term trading is much more recommended over the long term holding in the current circumstances. I would recommend to commit between 0.5 to 1% of your portfolio in Nikola and to split the allocation in batches of 20% at a time over the next 3 to 6 months.